Hello there. Lecture Series 20 of Bite-Sized Corporate Reporting focuses on IFRS 16 Leases. This is a 5-part lecture series. IFRS 16 sets out the principles for the recognition, measurement, presentation, and disclosure of leases with the objective of ensuring both the lessees and the lessors provide relevant information that faithfully represent those transactions. The following definitions are set out in IFRS 16. 1. Lease. A lease is a contract or part of a contract that conveys the right of use of an underlying asset in exchange for consideration. 2. Lessor. That is, an entity that provides the right of use asset and in exchange receives consideration. And 3. Lessee. That is, an entity that obtains the right of use asset and in exchange transfers consideration. Question: how do we identify if a contract contains a lease? A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So, when does a contract convey the right to control the use of an identified asset? Control is conveyed if the customer has both the right to substantially all of the identified asset's economic benefits and the right to direct the identified asset's use. According to IFRS 16, if the supplier has both the practical ability to substitute an alternative asset throughout the period of use, and it would be substantially beneficial to the supplier, this indicates the supplier has substantive right of substitution, and therefore the customer does not have the right to use an identified asset. Please note, the right to direct the use of an identified asset still exists even if any restrictions are put by the lessor within the contract, as these restrictions define the scope of right of use and does not prevent the lessee directing the use of the asset. Next, we will look at short-term and low-value asset leases. A lease is short-term if the lease term is 12 months or less at inception date. IFRS 16 avoids specifying a particular monetary amount below which an asset would be considered low value. However, IFRS 16 states tablets, small personal computers, telephones, and small items of furniture as examples of low-value assets. The assessment whether an asset qualifies as having low value should be based on its value when new. For leases that are short-term or of low value, IFRS 16 permits the lessee a choice to recognize the lease payments in the profit or loss on a straight-line basis. For all other leases, IFRS 16 requires the lessee to recognize a lease liability and a right of use asset. This will be discussed further in the second part of Lecture Series 20 on IFRS 16 Leases.